What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. This is part 2 of Something is Going to Break. And unfortunately, it might sound more bearish, but understand that there's always a silver lining in everything. Just because we might be surfing through some rough waters right now doesn't mean that it's not going to get better. We got a lot to discuss on today's episode, following up on just the previous one. That was part 1. I'll have that link in the description if you haven't watched it. It's up for me. Subscribe to the channel. Let's get on with today's episode. All right, everybody, let's hop into the 11 sectors, and we're looking at week-to-date performance. This is going to give us some insight into how people are positioning themselves in the market. And this last week, what I want to call out is really the top performing sectors. What do you notice here? So we have energy, no surprise, right? Energy's been going completely bonkers. We talked about oils, rising costs. Utilities was up almost 5% for the week. That is a huge move in utilities, and utilities are a defensive sector. Real estate, industrials, healthcare, consumer staples was slightly there in the red, but rather flat. Okay, so some defensive posturing pushing up the rankings on the 11 sectors. Towards the bottom of the list, what are we noticing? Financials. That is a big weight in the S&P 500. And notice that we talked about previously on the episode was what the yield curve was doing, how it was flattening out even more. Well, that is not necessarily good for financials. And you can see it was down 5% on the week. Some big names like American Express, Wells Fargo, Bank of America, they were getting hit. Then you have technology and also consumer discretionary down there too as well. In previous episodes, we talked about consumer discretionary being a laggard. And when you see consumer discretionary at the lower end of the list, but you see consumer staples up on the higher end of the list, now they're pretty even. So, they look like they're relatively just centered in the middle, but understand minus 2.6% versus flat. There's a big difference there, especially wherever your money's located. And we like to look at consumer staples as as needs. I always get them confused. Consumer staples is products that you need. Consumer discretionary, it's discretionary products, right? It's wants. People want these type of things. Think like, Tesla, right? Are there going to be, in times when times are tough, people typically flood to things that are necessary versus things that they just want. Okay, that is one way to look at it. Now, this is where it gets very interesting. If you've been following this channel, we've been talking about year-to-date performance in the 11 S&P 500 sectors. And let's look at year-to-date, okay? So year-to-date, energy has been the leader. There's no change there. It's up even more. 35% year-to-date. It's March 5th as I'm recording this. That's bonkers. But here's something interesting. Financials was the second place performer up until very, very recently, and now it's down almost 5% year to date. And look at what took the top 2 spots, now is in the top 3, utilities and consumer staples. So these were more towards the bottom of the list, and now all of a sudden they're catching a bid and moving up. And what do we see at the bottom of the list? Consumer discretionary. It's down 16% year to date. Consumer staples is pushing to the top. Consumer discretionary is down. What does that tell us right now? Well, in the time being, what that tells us is that people are positioning themselves more defensively. They're focused on the necessities, not necessarily the wants. And you can tell this because we are moving into a period where we are seeing slowing growth, and where we are moving into a period where loose monetary policy may no longer be, it'll be, instead of very accommodative, it'll be less accommodative. So when we pull that back, growth stocks typically are the ones that get hurt. Let's continue on to the relative rotation graph. This gives you a visualization of what's performing better than the S&P 500. We're looking at a 4-week tail length ending February 28th, 2022. So energy moving into the leading quadrant. No surprise there, right? But this is where it gets interesting, right? So we look at over here, what else is kind of creeping up? Consumer staples, it's in the leading quadrant. You got utilities turning right over here to the top right, leading quadrant. And you can see clear as day. Okay, these were, when we started talking about this earlier this year, they were actually kind of weakening in this quadrant. And we just said it looks clearly like they're going to be moving into a lagging quadrant, almost imminent. And sure enough, XLY, XLK, consumer discretionary, tech, growth, right? Boom. in the lagging quadrant. And what happens during this time when we see big names like this and we also see financials back off? Well, look at the market. Market's selling off right now, okay? So there has to be something to change. Now, like I said, there's always a silver lining to all of this. This is going to create opportunities, but opportunities are only valuable if you're prepared for when they arrive, right? If you are just holding and hoping that these things turn around and they do not, when the opportunities present themselves, it's too hard to jump in at that point. So it requires a lot of patience. Okay, what's going on from another visualization perspective? That's why I love charts so much, because you can visually just like see clear as day what's taking place. We're looking at the safety trade chart. Okay, so gold, utilities, consumer staples, bonds, defensive names, DEF is the ETF, and XLV. I'm comparing these relative to the SPY. So when the line goes up, it means that these defensive sectors or industries are performing better than the SPY. And if you just look at 2022, draw a line down the list, and you can just see from open to where it's at now, they all are moving up. There's nothing different. I keep on repeating this, and they keep getting stronger as it stands right now. So this is just more proof that there is positioning going into safety. And you got to understand, we are coming to the end of the first quarter. Yes, things can change, but it almost seems like people are preparing themselves, money managers, hedge funds, institutions, whatever the case may be. It looks like they're positioning themselves for not the greatest quarter around the corner. Things can change. We're seeing geopolitical things take place. It's getting rough out there, right? And, one news headline throws things around. The FOMC meeting is going to be out here fairly soon, right? And I guess the market's pricing in a 0.25 bip hike. Well, they can also come out and say, we're just not going to do it, and all of a sudden the market takes off. They could come out and say, we're going to do a 0.50, and then all of a sudden the market takes a hit, right? So anything could still potentially happen. I just want to visualize what is actually taking place in this current moment to prepare ourselves for what, if the trend is going to continue. We showed this chart on the previous video, right? Energy typically performs best at a market top. And then we get consumer staples, utilities, healthcare. As we start making that turn from a market top, those start performing better. And we're starting to see that take place here. That doesn't mean that we're coming to, an end. But I will say, with the yield curve looking like it's an imminent inversion, it almost seems as if we will be moving into a recession here at some point, very close. Now, another chart that I want to show you that's so important is financials. So financials make up a huge part of the S&P 500, and they're incredibly important to it. This right here is the KBW Bank Index. And I want to call out here, this is a monthly time frame, but what I want to point out is when we get up into this red zone area, this resistance area, which is no longer resistance, it is support, nothing's good has actually happened in this area. You can see we came up here in 2007, financial crisis. We came up here in 2018. We had the repo fiasco. Right here, pandemic. Now we're actually above it. But what we're starting to see is some large range candles with some narrow bodies. It's telling me that momentum to the upside is slowing. And a lot of indecision is taking place. This could change, but that's not looking good right now, especially this month. We're back below that 5 EMA on the monthly time frame. The PPO is starting to curl itself over. It looks like we might see some further weakness. The SPY is going to have a hard time next quarter, right, if the financials aren't helping support it, okay? If the financials aren't helping support it and we're coming into a tightening period, that's not good for tech. So when you look at the sectors, okay, when I talk about this, when you look at these sectors year to date and you see financials not doing good, discretionary, and tech, the big dogs. Now, the SPY's not doing all too bad relative to the other indices, okay? But that's because of this guy right here, energy. Clearly, energy is trying to hold everything up. And it's not even a big sector in the S&P 500, but it's holding things together. Versus like when you look at like the Nasdaq 100, because they don't have energy names. So as it stands right now, we are in a very dangerous area, especially if we get some continued weakness here in financials. Does it mean it's going to happen for sure? No, it doesn't mean that it's going to happen for sure. But it's not looking too good. We can take a look at the weekly time frame for XLF, and you can see here, well, the momentum's been diverging for some time. And we've been talking about that, right? This has been putting in just going lower, higher high, higher high, higher high, higher low, higher low, higher low. It's been diverging. So as this has been moving up, momentum's been slowing down. Now we're below all these key moving averages, and we haven't recovered that 5 EMA yet. And we're below all the other ones. We're back below the 50 on the RSI 2 as well, which we haven't been there I mean, for quite some time. Okay. If we take a look at the weekly time frame, but on this chart, I drew out a plot of what could possibly happen from a bearish perspective. And from a bearish perspective, you got to understand, okay, where can financials potentially go? Well, it's getting below all these key moving averages, right? And we're holding right here at this previous support, is once resistance. Maybe perhaps we do bounce up a little bit. But if we start cracking down, we can backtest and potentially head lower. And if that's the case, if we start heading lower to, the pre-pandemic high, that could be an area of support. And that's a long way down for financials. And that would put a lot of pressure on the S&P 500, which we're going to talk about the S&P 500 now on the weekly time frame. What did we do this week? We didn't go anywhere. It was just a lot of volatility. So if you thought this week was crazy, wait until next week. We're going to talk about just how big the range expanded. Well, we're below all these key moving averages. We got above the 5 EMA that is declining, but it held as resistance. So the bears have control as it stands right now. If we take a look at the daily time frame and we look at the risk ranges, okay? So the smaller gray was last week's risk range. Smaller gray, so from here to here was last week's risk range or expected move. We landed within it. No surprise there. A lot of volatility, a lot of chop back and forth. Now we have a larger risk range, so from 447.50 down to around 417.50. That is a lot of space to go up and or go down. This is why I'm saying volatility, like the percentage difference from right here, like this spread to this spread is quite large. So what that is telling me is, we're in a market that is going to continue to be very, very volatile. And understand that volatility, it's plus or minus, right? So I'm not saying that just because we're going to be very volatile, it's going to go straight down. That's not what I'm saying. We could very well see a big move up, but that doesn't change the fact that the market is still having lower highs and lower lows as it stands right now, at least the S&P 500, right? There's obviously bullish things taking place in other industries and other sectors. But looking at the S&P 500 right now, where could we potentially head up for the high end? Well, 447.50, low end, 417.50, okay? As it stands right now, we have a declining 50-day moving average. We're well below the 50 point on the RSI. So if we start heading up, even if we start heading up, we're still below a declining 50-day moving average. And we're, the 200-day is starting to flatten out here. And that could very well hold as an area of resistance in the near future. All right. Now, if we take a look at the 15-minute time frame, okay, we get to see more, candles here. We haven't gone anywhere. Right? It's literally, we're here, we close there, we got this markup towards the end of the day, we close right at around 432. And if you just look to the left of the chart, we haven't gone anywhere since the 21st of January. So we are setting ourselves up for some big moves here in the near future. And it's hard to determine whether it's going to be up or down because, well, the current trend right now is neutral in the short term, but in year-to-date terms, we have lower highs and lower lows. So the trend is bearish as it stands right now. And when I say that, it simply means that resistance is holding, support is breaking, okay? All right, let's take a look at the Nasdaq 100. So the weekly time frame, declining 5-period moving average, still holding as resistance, clearly. The 10-week crossed down through the 30 and the 40. They're starting to flatten out to decline. Clearly, wind is at our face. All right, no change there. Not the greatest looking weekly candle either. All right, remember, understand this too. Bear markets, they have monster rallies. We've seen that already a few times. If we take a look at the daily time frame, risk range, expected move, expanded, right? So the small gray, that we landed within it, right? We came towards the lower end last week, and we started moving up towards the end of the day. All right, so we closed within it. No surprise there. Now the range is actually bigger. So it's telling us that if you thought last week was volatile, we have a more volatile week up ahead, or at least the potential for a lot more volatility. Understand volatility can go both ways. We're well below the 200-day moving average. The 50-period moving average is clearly declining. So something is broken. It's going to take a long time for that to just resolve itself. Okay? And it did do the crossover, which is never good, right? So if it comes up, right, this is going to still head down. This is going to start curling itself over. It's going to hold as resistance. So it's going to take time. And understand that, the more people that are aware that there's a bear market, hey, this is a bear market, we could be coming closer to the end of a bear market, right? And what we've seen so far is a pretty big move down. We saw another big move down. In bear markets, you can typically get, 3-4 waves down. And right now, where are we? I mean, I guess it really depends on how you're really measuring it, but there could be still more room, obviously, to go down. Now, one thing that I'm watching is this trend line kind of holding right there. So that is one to break, that is one to watch, but understand that we're still below these key moving averages. So from the high end on the risk range is around 350 to the low end is about 325. That's what we need to pay attention to. As it stands right now, these rallies have been getting faded, so be very careful in the tech sector if you are trying to go long in the tech sector. You got to be very tactical. If you take a look at the Qs on the 15-minute time frame, below that 5-day moving average, okay, and where have we been, right? And we close right here. We haven't gone anywhere since pretty much the 24th of January. It's just been one heck of a vol. All right, everybody, we are taking a look at the sailor to shift ratio. Okay, and as it stands right now, well, we got some more weakness at the week close of Bitcoin. And we're still on that sell signal. I highlighted these as false signals. If you don't know what that means, like how do I determine if these are false signals, you're gonna have to watch the video that I put together on how to use this chart, how to set it up. I'll try to remember to put the link in the description, but as it stands right now, quick update, we are still on a sell signal. If we take a look at the price of Bitcoin, you can see we saw some weakness. Now, I posted this out on Twitter, and it's an interesting sentiment indicator. So when we had this plus 15% day, you probably know which one it is, right? This big, huge move to the upside. There was just an incredible amount of bullish sentiment out there. And to me, what that just said was like, it tells me that the big time bulls in Bitcoin, in crypto, they were getting beat down and they needed anything to feel extremely confident because the confidence went through the roof. And that type of sentiment, it tells me like, okay, this could easily get faded. And the sailor to shift ratio, people are asking, is it ready? Is it a buy signal? I'm like, no, it still isn't yet. And not to say that this is the holy grail by any means, which it's not, but there was an indication there telling us that like, okay, this is a very strong move. People are getting overly confident about this and it got faded. Now that doesn't mean that it's not going to just go right back up and break down, but these are the trend lines that I'm watching. All right, we hit it here, 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 and here, and here. Okay, so that is what's, Bitcoin. If it starts closing below that, we might break lower, right? To around 30,000. If we start cracking down 30,000, it's going to be a wild ride. And if we start getting back above this, understand we're still around the 200-day. So it can come down and then do this. I'm not ruling that out by any means, but I need the signal to flip in order for my strategy to enter in. But as it stands right now, I'm on the sidelines. And simply because I like to wait for this signal. Now that's just with Bitcoin. There's other cryptocurrencies out there, obviously, that may be setting up to as well. But I'm just taking a look here at Bitcoin and Ethereum. And Ethereum here is holding the lower range as it stands right now. So it acted as resistance, didn't quite come up again like Bitcoin did, and started to reverse that big time move that we saw just a few trading sessions ago. And now we're starting to hold a little bit more as support, but understand we're below all those moving averages. If we take a look at the relative strength line, Ethereum to the S&P 500, it is acting very well, or in high correlation to tech stocks or to the Nasdaq. And you can see here we are underperforming the S&P 500 year to date, and we're back below that. We've been below that 50-period moving average. Bitcoin was above it for a second, and then it whipsawed right back down. And we are still, slightly underperforming the S&P 500 from a year-to-date perspective, looking at relative strength. All right, let's get into some indicators now. Let's first take a look at this health dashboard, looking at the Nasdaq Composite. So the Nasdaq Composite, this is, I would consider this bear market territory, right? So we're down 18%. Typically it's 20%, but we've already hit there. But here's the reality. We have a high, lower high, lower high, lower low, lower low, low low. So that the trend is down, right? So that is what it is. We're below these key moving averages. Understand if we start moving back up, the 200-day is starting to decline here. The 50-period is already declining. So it's going to hold, and it's going to take some time for that to get resolved. If you take a look at the PPO, bearish crossover taking place. Okay, we've had new lows building for quite some time as an indication, telling us that something was taking place. If you take a look at the relative strength between the composite and the S&P 500, well, it's well below, their 50-period moving average, and it's still pointing down. The NAMO, bam, it's below zero. That's not a bullish sign. And then the advanced decline line too has been continuing to die off as well. So it's hard to see any strength. If we take a look at the NIAD, the advanced decline line, New York Stock Exchange advanced decline line, you can see here, first and foremost, we did break down, we backtested, and we started heading lower. Okay, and as you can see here, this is the NYA, New York Stock Exchange. This is the broad market. How's the broad market doing? You can see here, it's been holding up on this area of support and it has not broken down yet. Meanwhile, the internals have broken down. So if this starts breaking down, if we get a close below this 16,000, that can spell out further downside. And as it holds right now, I mean, we have a high, lower high, lower high. That can change, right? And we're getting some very big, wild swings, which to me looks like periods of distribution. This is something very similar to what we saw in the IWM, where the IWM shot up, right? Boom, and then we came back down and we started closing below that very long-term channel. This channel is almost a year long now, going just back and forth, back and forth. So we haven't gone anywhere. If you just look to the left of the side, left of the chart, you know, since May of 2021, we're in the pretty much same spot. Okay, now as far as some sentiment goes, it's getting pretty bearish, right? So the asset managers, it's now getting a 30.30 reading. We haven't seen that low of a reading really since the pandemic. And typically when you get these very low readings, we're nearing a market bottom. But understand, this is just sentiment. Sentiment is not really a great signal chart, right? And the thing is, if you have to look at a sentiment chart to understand sentiment, clearly it's not that bearish, right? So if you're wondering, hey, are we, very bearish right here? If you have to wonder that, chances are we're not that bearish. We knew how bearish it was over here, right? And over here. That was clear. You didn't really even need a chart to understand that, but it felt like the world was ending, right? As it stands right now, people are still holding on to hopes and dreams. But if you look at the RIDEX, if you look at the asset managers, we are seeing some very large moves to the downside here. So that is something to be cautious of. And it lets us know that, hey, even if we get a little bit more further downside and this heads lower, we could be coming close to that bottom of the bear market, right? We'll see. We will see how crazy this gets this next quarter, especially moving into a tightening cycle. Now, here are a couple other sentiment indicators, right? Volatility, fear index. Like, this is crazy, right? So we put in a shooting star candle, right? So that could mean that we're going to back off. That could relieve us a little bit here in the S&P 500 next week, which could put us to the upper end of the risk range. But just take a look, right? Higher highs, higher lows. Volatility is trending up, right? So volatility is moving higher right now. Not just the VIX, but the VXN, Nasdaq volatility. It closed just basically on 35. It's moving up higher, right? It's trending up. You can see right here, higher lows, higher highs. Bam. Okay. And then on top of that, you got Russell volatility. Russell volatility and Russell 2000, it is in a bear market, right? So it's trending up. When you're above these ranges, understand that you're dealing with just very, very large waves, a lot of chop. You need this to come way down to feel a lot more confident. Or you need trend to start breaking to the downside to feel a little bit more confident that, hey, there might now be some hope where the market can start turning around. But as it stands right now, you just got to be very careful. Now, if we take a look at a couple indicators that Michael Gayad uses as part of his award-winning research, XLU over SPY with a 4-week rate of change, completely fired off to the upside. And we know that because utilities took off. This right here means risk off. Boom, risk off. All right. That means not necessarily that, hey, the market's going to crash, but what it means is we're in an environment where you might need to take your foot off the gas a little bit. All right. And by that, I mean, okay, we could see continued increase in volatility and we could see large swings. So, this is interesting. If you haven't read his white paper, I suggest you go do that. Same thing with this one, lumber to gold ratio. This is actually risk on at the moment. Okay. So it's still above 0, but just take note that it is pointing straight down. And if we start getting below 0, that is another one of his indicators that would be flipping to risk off. So that means you would have, multiple of his indicators. And, the more indicators that you have in a risk off environment, the more careful you need to be. And you got to understand these, when they go risk off, it doesn't mean a crash is going to happen, but it has been in front or very close to every single, big crash. It lets us know that, hey, the weather's choppy, volatility, we could get surprised here. And we need to be very careful, okay? All right, everybody. That's all I got for you on part 2 of something is going to break. And I hope that you understand here that some of the charts that I showed you, some of the things that are going on with trending volatility, with the rotation into safety, how we're continuing to see that, how we're moving into a period where we're seeing slowing growth, can see continued slowing growth, right? And inflation, we might be coming to a period of inflation where we might get higher inflation, but the rate at which it moves up higher is slowing down, okay? And we're coming into a period where the Fed is going to try to tighten more into this environment. It is a very difficult environment to navigate. So if you are new to the markets, right? If you're new here trading, just understand, like, you just lower your position size. Take it easy. Take it easy here. There will come a time where the weather, it gets bright and sunny, where the volatility comes back down and we can go right back into a bull cycle. But you need to be available and you need to be prepared for when those opportunities arise. And as we're standing right here, right now, it's a very, very difficult environment. I don't know how many times I can say it. All right, everybody.